got Morgan Stanley that has initiated an overweight on Swiggy. Hersh is joining in to tell you more about that. Hersh, one stock that has disappointed a lot of investors that got in early, and I think this is going to be music to their ears.
Absolutely, 22% upside is what they see. And probably the last piece of what I'm going to say is going to be most important. So I'm going to start off first with the business itself. It's a duopoly market is what Morgan Stanley suggests. They're saying current market share trends likely to sustain in their opinion. The food delivery business for Swiggy is likely to grow at around 16% CAGR FY25 to 28. They're seeing Swiggy could regain some market share where quick commerce is concerned. They're expecting improved execution, which should likely lead to better outcomes on the quick commerce side of things. The margin gap, though, is likely or is expected to close versus Eternal Zomato, at least in the food delivery space. So in the food delivery space, they expect Swiggy to deliver around a 4.8% adjusted EBITDA margin in FY28 versus the 6% which Eternal is expected to deliver. Quick commerce, though, they're seeing a sharp differential. They're seeing FY31 margins at 2.6% for Swiggy versus 4.7% for Eternal, or rather Blinkit within that Eternal universe. Operating leverage differences is why they believe that this gap will likely persist. So therefore, what's the appropriate discount to market leader that Swiggy should trade at? That's what they're really trying to answer. They're saying that food delivery is implying a 52% discount to value, quick commerce around a 25% discount to value. Overall, they're looking at around a 50% discount to value in their target price. That's what they're building in, and despite that, they're giving it a target price of 405. Therefore, they're finding comfort in this one, 22% upside.
Right, so a 22% upside is what Morgan Stanley is looking at on Swiggy. In fact, Sunny, let me come to you. Swiggy, Zomato, all of these that have been in focus as well from the quick commerce space right now. How are you looking at trading in these counters? Would you say these could be buy calls, taking into consideration the valuations as well?
Yeah, I think both the players are likely to struggle in terms of margin, at least for next 2-3 quarters, looking at the way competition is shaping up in a quick commerce space. And there is some slight indication that even there is a slight slowdown as far as food delivery business is concerned by both the players. So I think maybe if somebody is looking for a long-term investment horizon, then one can gradually accumulate both this stock over the period of next maybe 1 or 2 quarters. And then we expect that maybe FY27 is a year where because once the competition wanes off for both the players, then FY27 should be the year where we can see a significant ramp up in terms of margin expansion. So again, a long-term play, one can gradually accumulate these stocks.